Good morning and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's check what happened overnight. Plenty, it would seem, a rebound on global markets after US President Donald Trump suggested the US-Israeli war on Iran could be close to an end. Now, earlier in the session on Wall Street, oil prices reached their highest level in almost 4 years, prompting a steep sell-off in shares. However, news that the G7 was considering releasing strategic oil reserves saw a dramatic reversal, with the oil price falling and stocks rebounding to finish positively. The Philly Semiconductor Index was a clear outperformer, with chipmakers SanDisk, Broadcom and Nvidia posting solid gains. Home builders and the banks initially fell before recovering, certainly as far as JP Morgan was concerned. Travel-related stocks, they remained under pressure, including Booking.com and Expedia. And Paramount Skydance was also among the worst performers. Prior to President Trump's statement, European shares hit their lowest level in more than 2 months. Well, President Trump has told American media that I think the war is very much complete. Pretty much, he said. They have no Navy, no communications, they've got no Air Force, and he said the US is very far ahead of its initial 4 to 5 week estimated time frame for the conflict. Well, meanwhile, central banks across Europe have come under market pressure to lift interest rates as the war fuels energy costs. Money markets upping bets on rate increases by the European Central Bank, Swiss National Bank, Sweden's central bank before the end of year, with the Bank of England seen as following suit next year. And the sharp repricing came after crude surged above $119 a barrel. IMF Managing Director Kristalina Georgieva warning of inflation risks from the conflict, saying a 10% increase in oil prices, if persistent through most of the year, would result in a 40 basis point increase in global inflation. She said, "My advice to policymakers in this new global environment is think of the unthinkable and prepare for it." Well, the US 2-year Treasury yield has fallen to 3.59%, the 10-year around 4.13%. Australian 3-year government bond yields fell to 4.5%, the 10-year at 4.89%. Markets pricing in a 30% chance the RBA cash rate will be hiked by 25 basis points at next week's meeting and 100% by May. US dollar index, that was down around 0.5% on the day. The Aussie has rebounded to 70.7 US cents. And oil prices have fallen after soaring by as much as 29% during the session as Saudi Arabia and other OPEC members cut supplies amid the growing conflict. Prices retreated as the US and other G7 countries considered tapping strategic petroleum reserves to limit inflation pressures from energy price increases. Brent crude having since tumbled to $92 a barrel. Gold has fallen, pressured by a strong US dollar and expectations of higher interest rates. Spot gold currently around $5,135 an ounce. Copper was higher. Iron ore rising close to 1% to 105 US a ton. And Bitcoin is back up to close to 69,000 US dollars. Right, let's get across those dramatic market moves. Steve Sosnick is Chief Strategist at Interactive Brokers, and he joins us again now. Steve, welcome. I was just saying before we came on, it feels as though we've got whiplash in these markets at the moment. Have you ever seen something like this in the oil market and also what we've seen with equities?
Good morning, Andrew. This is about as crazy of a move in oil as I can remember, which would pretty much put it up there for about the craziest move in anything that I've seen. We're talking about essentially a bull market and a bear market in one afternoon. That's as nutty as you can get. Now, I one of the things that had been underlying this market there's been a bid the entire way, and this is a chart that I put out earlier this morning our time, and you can see that pretty much every day. This is the last 6 days of the S&P 500. Every single day, with the exception of Friday, we tried to rally significantly off the day's lows. And today, obviously, we were able to accomplish that in spades because the news flow justified it. Now we're starting to see futures sell off a little bit because maybe he overspoke. The president overspoke, overpromised. But for the most part, this is a market that has been primed to try to look for a rally and try to buy dips. And you could see that from the way the activity was, that we were never really able to maintain a significant sell-off any of the days since the conflict started.
Well, you feel as though the president had to say something because he looks at those key barometers, doesn't he, as far as opinion polls, but also the stock market clearly. So perhaps, as you say there, markets now just interpreting what he had to say there. But clearly the key there was he said the war is near an end, but also, obviously, as far as oil is concerned, the G7 nations, they're looking to tap their strategic reserves.
That's why we came off the lows early today, and that's why oil came off the highs. It was the strategic reserves. That's a band-aid, though. It doesn't really solve the problem of getting tankers through the Gulf, and it's still not clear that they're moving yet or will be moving anytime soon. But obviously, the shorter this problem lasts, the better this is for everybody. But there's still it's not clear that Iran is going to go down without at least trying something. I think if I were on a tanker going through the straits, I would be a little bit nervous to watch for drones. Insurers are probably still a bit nervous, despite the fact that the U.S. implied that they would backstop insurance. It's not clear for whom and how much. Or is the U.S. going to backstop insurance on tankers going to China? These are unanswered questions, and so there's still there's still a lot to be resolved here. But I guess on the one hand, I guess on the most important sense, the market's optimism remains unfettered, and basically was given a boost by the president's comments. And now we'll see, to what extent that was a bit of hyperbole and a bit of, saying what the markets wanted to hear versus the reality, on the ground and in the water.
Yeah, so I mean, essentially, it's back to markets holding out for the taco trade, isn't it? So, in regards to equities, then, Steve, I mean, how do you play this?
I think you've got to manage your risk here and realize, this is my standard piece of advice when we get moves of this type is do a gut check. If this move really bothered you, then you're carrying too much risk. If this move didn't, that's a different equation. Then maybe you should be considering and staying invested and staying long and keeping to your plan. Now, one of the things in the U.S. versus markets, in much of the world, is our moves have been much more muted. I'm not even going to go into Korea, which has been truly nuts. But when you think about Japan moving 5-6% a day, there's some global markets that are really moving. Whereas as of this morning, the S&P was down what two and change percent. That's not a sell-off. That's if that bothers you, if a move of that minor magnitude is problematic. You probably want to de-risk and start to think about more short-term fixed income and less volatility. If, on the other hand, you realize this is a 2% move and you stick to your plan, and then there'll be some other thing that'll try its best to disrupt us. But the resilience in the U.S. is actually so stunning amidst individual investors, particularly, but amidst investors of all stripes. As you said, this is the mother of all taco trades in some regards. Basically, at some point, does victory get declared just to ameliorate the problems in oil and the markets, or what is the end strategy? I must say we've gotten several different metrics for what would constitute success in this conflict, and truthfully, the benefit of that, I guess, would be if you could check any box, then you could say that it's a success, and so that eases the pressure on on the government to keep this thing going.
Now, Steve, of course, this comes at a time, fairly tricky time for the US economy, you would think, in balance, because there's still sticky inflation, obviously, plus also we've seen some softer hiring conditions at the same time. Now, there is some key data coming to your way this week, isn't it, just in terms of inflation, CPI for February, also the PCE index.
Yeah, this is going to be a big week from inflation. Certainly, one of the jobs numbers on Friday were, I don't even know how to say, I'm trying to think of a better adjective than awful, but they were not good. I mean, we missed by, when you throw in the 2 month revision, we missed by over 200,000 jobs. That's fewer. Now, again, you could argue, all right, well, there's a labor force of, 170 million or so. What's 200,000 here and there? But the move is in the wrong direction. That puts pressure on the Fed to consider cutting rates. But at the same time, obviously the energy issues are inflationary, despite the focus on the core. But even there, core rates have not been super cooperative. They've been okay. And so I do think the Fed is in a little bit of a bind here. And as we saw over the last week, I'm just just checking my screen now. Yeah, we're still looking at the first rate cut priced in for September. Now, remember, about a month ago, that was June. So we've pushed back a couple meetings. Also, we're now looking at, not the full likelihood of two rate cuts this year, but about, one and change is the probability, one and about 0.7 right now. So, this is telling us that the Fed is in a little bit of a bind. And if it does prove that the jobs figures are so bad that they will require the Fed to intervene, that's not necessarily good either, because that means the economy needs a little more work than we'd hoped for. So I'm always rooting for a strong economy. I think it just benefits investors worldwide to have a strong global economy. But obviously the Fed has got to really keep an eye on inflation, and we'll learn more as the week goes on.
Yeah, well, the alternative is not very appealing if you talk stagflation at this point, is it, Steve?
Yeah, well, stagflation is really what that is like the second dirtiest word for the market. Deflation is the dirtiest, and when we're certainly not seeing that. At least as long as private credit doesn't start to unravel, but that's a discussion for another time.
Oh yes.
But I think right now, the bigger concern is stagflation, because it puts central banks in a bind. They want to cut. They need to cut to keep one part of the mandate, but literally the mandate is fighting amongst itself. It's a very difficult situation for any central banker to resolve.
Steve, great to get your analysis. Thanks for joining us from Interactive Brokers.
Thanks, Andrew. Take care.
Let's turn to the local market now. Speaking of whiplash, we're certainly getting that on the local market, given where we fell yesterday. At one point we were down 4%, if I can remind you, ending up about just over 2.5% lower. So we're looking to regain those losses in today's trade, reflecting what we have seen, particularly on Wall Street overnight. And we'll get right across those market moves in just a moment with the open. Stay with us.